Hi there, I had to start investing today from scratch. Knowing what I know about SoFi's latest quarter, the AI spending boom, the data center squeeze, and the way this market is rewarding some stories while punishing others, I would not start by asking, do I buy the dip? That's too simple. I would ask something much more uncomfortable. Am I buying a business that is getting better, or am I just sitting in a stock that the market refuses to care about right now? And today is Monday, May 4th, New York time. Comment below what day and date you're watching from, because I always like seeing where this community is tuning in from. And quickly, if you value this kind of research, subscribe and comment John A.G. Best below. That tells me you want more of these deeper breakdowns, and it helps support the work. So in this video, we're going to walk through the real question: buy the SoFi dip or double down on AI? And I don't mean that in the lazy way, where we just say one stock is good and the other stock is bad. I mean the actual investor problem. Because SoFi can be fundamentally better and still underperform. AI can look expensive and still keep moving. Memory stocks can look like they've already run too far and still be backed by real demand. And big tech can be spending insane amounts of money, and that spending can either be genius or it can be the beginning of a margin problem. That's the market we're in. Now let's start with SoFi. Based on the latest company filing, SoFi just reported record quarterly revenue a little above $1 billion, adjusted revenue also around that same level, and adjusted EBITDA in the mid-hundreds of millions. Member growth was still strong, products were still growing, and management maintained a full-year outlook calling for roughly 30% annual revenue growth and adjusted EPS around 60 cents. That is not a broken company. That is not a company falling apart. That is a business still scaling. But here's the problem. The market didn't need SoFi to be not broken. The market wanted clean excitement. It wanted a guidance raise that made people go, okay, the next leg is here. Instead, SoFi gave investors a quarter with strong headline numbers, but also enough little questions to keep the doubters alive. The technology platform is the big one. That segment's revenue fell by the high 20s year over year, and enabled accounts were down in the mid-teens, partly because of a large client that had already moved off the platform. That doesn't destroy the SoFi thesis, but it does make the platform story less clean than bulls wanted. And when a stock is already falling, less clean becomes a big deal, because investors don't react to numbers in isolation. They react to numbers plus expectations, plus emotion, plus what every other stock is doing around them. If SoFi reports a solid quarter while AI names are ripping, people don't say, great, fundamentals are improving. They say, why am I still here? That is opportunity cost. And opportunity cost is not some academic term. It is the feeling you get when your stock is down while your friend's AI stock is going up. It is the feeling you get when the company you own is slowly executing, but the market is paying premium prices for the companies building the AI infrastructure layer. And that's why this debate is so important. SoFi's bull case is simple. It has deposits, it has lending, it has financial services, it has brokerage, it has crypto back on the platform, it has fee-based revenue, it has a growing member base. It has a funding advantage from deposits, and those deposits are now massive compared with where the company was a few years ago. In the latest quarter, deposits increased by a few $1 billion to just over $40 billion. That's real. That's not hype. But SoFi's bear case is also simple. If the market keeps viewing it like a bank, it may not get the multiple bulls want. If the technology platform keeps disappointing, the platform story gets weaker. If rates don't help soon enough, lending can stay under pressure. And if AI keeps eating the market's attention, SoFi might stay cheap longer than people expect. And cheap for too long can become expensive in your life, because time is part of the return. Now let's compare that to AI. AI right now is not just a theme, it's becoming the center of the market's spending cycle. Look at what's happening with big tech. Meta just reported revenue up in the low 30s year over year, daily active people still in the billions, and capital spending guidance now in a range that goes well above $100 billion for the year. The company specifically pointed to higher component pricing and more data center costs. That tells you something. The AI boom is not just software engineers typing prompts. It is chips, it is servers, it is memory, it is buildings, it is cooling, it is electricity, it is a physical supply chain hiding behind a digital story. And this is where the memory conversation matters. Memory used to be treated like a boring cycle. Prices go up, earnings explode, companies spend, supply comes online, prices collapse, and everybody promises never to touch memory again. But AI is making that cycle more interesting. Advanced memory is now part of the bottleneck. Reuters reported that Micron's strong outlook was tied to booming AI demand and tight supply, and that advanced memory demand from AI data centers has pushed prices higher. So when someone says memory stocks have already run too much, I get it. Nobody wants to buy the top. But when someone says Memory stocks are automatically done because the chart went up. That's too simple. If earnings are moving faster than price, the stock can look crazy on the chart and still not be crazy on the numbers. But here's the counterpoint. Memory is still cyclical. Don't let one hot AI cycle trick you into thinking physics, supply, pricing, and competition disappeared. If you buy cyclicals like they are forever compounders, the market will eventually remind you why that's dangerous. That's the same lesson with AI more broadly. Nvidia is still the king of the AI hardware story. Its last reported quarter showed revenue around the high 60s of billions, data center revenue in the low 60s of billions, and huge year-over-year growth. That is why the market keeps treating Nvidia like the scoreboard for AI demand. But even Nvidia can report great numbers and still wobble if expectations are too high. That's the new problem. AI companies are not just being judged on whether they are good. They are being judged against perfection. When expectations are that high, good can still be punished. Google is another important piece. Alphabet's latest quarter showed total revenue around $110 billion, with Google Cloud growing at a very strong rate, helped by enterprise AI demand. The company's own release also said Google Cloud backlog was above $460 billion and nearly doubled quarter over quarter. That is not a small signal. That is the market saying AI demand is turning into contracted infrastructure demand. And that's why SoFi holders feel pressure. Because SoFi is saying, look at our improving financial model. AI infrastructure is saying, look at the largest companies in the world fighting for capacity. Those are different emotional experiences. Now, should you sell SoFi and chase AI? Not automatically. This is where a lot of investors hurt themselves. They wait through the pain, then sell when the pain is obvious, then buy the thing that already worked, then that thing finally cools down, and suddenly they own the top of the new story and sold the bottom of the old one. That's not strategy. That's emotional rotation. So the real question is not which stock went up recently. The real question is, what do I own, why do I own it, and what would prove me wrong? If you own SoFi because you believe it can become a much larger digital financial platform, then the latest quarter gave you both support and questions. Support because revenue, members, products, deposits, lending originations, and profitability are moving in the right direction. Questions because technology platform weakness and guidance conservatism make the re-rating story less immediate. If you own AI because you believe the infrastructure cycle has years to go, then the latest data supports you. Big tech capex is rising. Cloud demand is strong. Memory is tight. Data center power needs are becoming serious. But your risk is valuation, crowding, and expectations that may already price in a lot of good news. And if you own neither, then maybe the answer is not to pick a team like it's a sports game. Maybe the answer is to build a portfolio where SoFi is a measured re-rating bet, AI is a measured infrastructure bet, big tech is a cash flow plus AI bet, and energy is a second-order data center bet. Because energy is where this story gets very real. The International Energy Agency says data center electricity consumption is projected to more than double by the end of the decade, and in the United States, data centers could account for nearly half of electricity demand growth through then. Reuters also reported that U.S. power use is expected to hit new highs in 2026 and 2027, with AI and crypto data centers a major driver. That means the AI trade may not just be Nvidia, it may not just be cloud. It may be power generation, grid equipment, transformers, cooling, natural gas, nuclear, and transmission. The picks and shovels are getting wider. And that brings us back to SoFi. SoFi is not a picks and shovels AI company. It is a digital financial services company. That means its drivers are different. Rates matter, credit matters, deposits matter, consumer strength matters, regulation matters, investor sentiment toward fintech matters. This is why SoFi can look cheap and still not move with the AI crowd. But different does not mean bad. Sometimes the best opportunities happen when the market is looking somewhere else. If SoFi keeps growing, keeps increasing profitability, keeps building deposits, and eventually turns the platform segment back into a growth contributor, the market can re-rate it quickly. Stocks do not move in straight lines with fundamentals. They ignore fundamentals, then suddenly overreact to them. But you need patience for that. And patience is easier to talk about when your neighbor isn't making money faster than you. So here's the practical way I'd think about it. If SoFi is a small or medium position and you still believe the business is improving, buying the dip can make sense. Not because it has to bounce tomorrow, not because it has to go back to some old high, but because the business is larger, more profitable, and more diversified than it used to be. If SoFi is your entire personality, then no. That's not investing, that's emotional concentration. The same goes for AI. If your portfolio is so AI heavy that every Nvidia earnings call feels like a medical exam, you might not be investing anymore. You might just be surviving volatility. And if you're successful, share your success story in the comments so others can stay motivated. Seriously, because people need to hear real stories from people who stayed disciplined, sized risk properly, and didn't blow themselves up chasing every green candle. Now, Meta is a good example of this tension. Investors saw rising capex and got nervous. Fair. Spending that much money should be questioned. But Meta also has billions of daily users across its apps, strong ad growth, and a business that may actually become more efficient with AI. If AI improves targeting, creative tools, conversion, and ad performance, then Meta's spending may not be waste. It may be defense and offense at the same time. Google has a similar setup. People worry AI will disrupt search. That risk is real. But Google also has cloud, custom chips, massive distribution, YouTube, Android, and a backlog that says customers are still lining up for compute. So the market has to decide, is Google being attacked by AI, or is it monetizing AI from multiple angles? Amazon is the same kind of debate. Is AWS spending too much, or is AWS building the capacity customers are begging for? If cloud capacity is tight, capex can look ugly today and brilliant later. But if demand slows, that same capex becomes a problem. This is why I don't like one-sentence investing. Buy SoFi because it's cheap is too simple. Buy AI because it's the future is too simple. Sell everything not AI is dangerous. Never chase AI because it's a bubble might also be wrong. The better answer is that SoFi and AI are different bets with different clocks. SoFi needs execution plus re-rating. AI needs demand to keep outrunning supply and expectations. Memory needs pricing to stay strong longer than the market thinks. Energy needs data center demand to keep forcing grid investment. And your portfolio needs to survive being early. Because sometimes early is smart, sometimes early is just painful, and sometimes early is wrong. Your job is to know which one you're dealing with before the market makes the decision for you. So yes, I think the SoFi dip is worth studying. I also think AI remains too important to ignore. But I would not let frustration with SoFi force me into chasing AI blindly, and I would not let loyalty to SoFi make me pretend the opportunity cost isn't real. Own the thesis, size the risk, recheck the data, and don't confuse a stock being down with a business being broken. Nothing here is financial advice. This is only for education and research, and you should treat it like a framework, not an instruction. Do your own work, check the filings yourself, understand your risk, and make decisions based on your own time horizon, not somebody else's excitement on a live stream.